Financial markets are not a casino, but you can absolutely turn them into one by the way you approach them. And that's why many Christians struggle with the question, is trading basically gambling? Today I'll answer with two foundations: probability and biblical wisdom applied to reality. Many Christians do not fear markets. They associate uncertainty with greed, gambling, and loss of control. But uncertainty is not the enemy of faith. Ignorance is. The market is not chaos. It is a place of exchange where reality applies laws, time, risk, volatility, and consequence. Ignore those laws and you do not become spiritual. You become vulnerable. Also, this is not financial advice. This is about discernment and wisdom. We'll do this in two parts. First, a clean framework called expected value. It will help you separate gambling from markets. Second, why people lose money in financial markets, starting with volatility and leverage, then day trading behavior, costs and market structure, microstructure, and finally the spiritual trap where confidence replaces truth. Let's start with one concept that quietly runs the entire world of trading and risk management: expected value, or EV. EV is not simply your chance to win. EV uses probabilities, yes, but it is the average payoff you should expect if the same trade or investment is repeated many times. In plain English, EV combines two things: how often outcomes happen and how big the payoff is when they happen. So a strategy can win most of the time and still be negative EV if the occasional loss is large enough. Let's make this concrete. Imagine two strategies. The first strategy wins 8 times out of 10. 8 times out of 10 you win 1, and 2 times out of 10 you lose 100. You will lose 192 in the end. The second strategy wins less often. 4 times out of 10 you win 10, and 6 times out of 10 you lose 1. You will win 34 in the end. To the human eye, the first feels safer, but it is not because the EV is negative. This is why professionals do not worship win rate. They look at structure, payoff, risk, asymmetry, and tails. If you remember one sentence today, remember this: a high win rate can still hide a losing structure. Now here's why EV matters. Because of the law of large numbers. The law of large numbers is simple. As you repeat a random experiment many times, the average outcome moves closer and closer to the expected value. Randomness can bless you short term, but over time, structure reveals itself. That is the difference between pure randomness and a world governed by law. Repetition exposes what is real, and that is why, in markets, time is not your friend or your enemy. Time is the auditor. This is why gambling is fundamentally different. In casinos and most sports betting, EV is negative by design. A bookmaker is not paid for being right. He is paid for building a margin into the odds. And the business model is simple: trigger appetite, increase repetition, and let time do the extraction. That is why negative EV structures are spiritually dangerous. They monetize urgency, greed, and coveting. This verse does not condemn work or responsibility. It describes what happens when money becomes an idol. Urgency rises, coveting grows, and sorrow follows. Negative EV systems are built to trigger that appetite, because repetition is where the edge becomes inevitable. Now compare that to financial markets. Markets are a meeting place. A price exists only because, at one precise moment, a buyer agrees to buy and a seller agrees to sell. The next transaction may happen at a different price, and the next one again. Today, this process happens thousands of times per second. Prices move as transactions, information, flows, and uncertainty change. There isn't one single house setting fixed odds against you the way a casino does. But do not romanticize it. On short horizons, friction can become a constant opponent, especially when volatility spikes. Spread, slippage, execution quality, and fees. So even when the market itself isn't a casino, your time horizon and your behavior can place you in a structure where friction behaves like a constant tax. A false balance today can look like hidden costs, misleading performance claims, or selling certainty where none exists. Biblical wisdom is not anti-market, it is anti-deception. Now the nuance. In gambling, your decisions do not meaningfully change the house edge. The structure is fixed. But in markets, decisions can matter because you are operating in a dynamic environment, not a fixed odds house. Skill is not predicting perfectly. Skill is building policies, how you select conditions, how you size, how you manage risk, how you exit, how you adapt, after costs. And that is why counting the cost is not optional. In markets, counting the cost means you quantify risk before you chase reward. You respect volatility before volatility punishes you. Now, why is the internet full of proof that proves nothing? Because even if a strategy is EV neutral around zero, randomness will still produce outliers who look consistently profitable. With enough participants, someone will walk a lucky path. Those become testimonials. The rest get blamed for not being disciplined. That's survivorship bias turned into marketing. And here is a simple institutional logic test. If an edge is truly scarce and capacity limited, mass marketing destroys it. So when you see strategies scaled through ads, often the product is not the edge. The product is the audience. Now we move from structure to practice. Most people do not lose money because they lack motivation. They lose because they reverse the order. Wisdom starts with opportunity. Where is volatility real? Where is risk actually priced? Where do macro conditions and liquidity create pressure? Then you measure it. Then you size it. And only then do you execute. Retail often starts with execution, a chart pattern, and then adds leverage to force meaning out of noise. Technical tools can help execution, but they cannot replace understanding the structure. Here is the mistake that destroys most accounts. People do not identify real volatility. They do not identify where the true opportunity is. They lock themselves into one horizon, intraday, and call it discipline. But if there is no meaningful volatility linked to fundamentals, then staring at a screen all day is not discipline. It is exposure to noise. If there is no opportunity in the underlying movement, the only way to manufacture results is leverage. And this is what most day trading becomes. Not harvesting real opportunity, but forcing activity on small moves. Forex is the clearest example. Most days, major FX pairs move below 1%, often far less. There are rare sessions with larger moves, usually around major events, but those are not the daily norm. So if the underlying moves are small, and you want large returns fast, you have to manufacture volatility. You manufacture it with leverage. And here is what leverage really does. It does not only amplify profits, it amplifies noise, it amplifies execution errors, it amplifies the cost of being wrong by a small amount. What many retail traders call a setup is often just them getting caught in repricing and rebalancing flows from larger players, hedgers, market makers, institutions, where your account is too small to influence anything. You are not moving the market, you are being moved by it. That is why short-term leverage day trading often feels like chaos. You are trying to harvest pennies inside a current controlled by bigger flows, and your leverage turns tiny turbulence into damage. A small move becomes a violent event. Leverage is debt. Debt creates dependence. Dependence forces timing. and forced timing is how accounts die. If the market is not offering real opportunity, wisdom says step back, read, learn, pray. Because your screen is not an altar, and noise is not obedience. Now the second accelerant is costs. Every trade pays rent, spread, slippage, execution, fees. Day trading multiplies that rent because every entry and every exit is a payment. If you trade every day, you pay every day. If you trade many times a day, you pay many times a day. But if you hold a position longer, when the opportunity actually exists, you reduce the frequency of paying that rent. Over 5 or 10 years, this difference is massive. Even if you are right often, high activity can still bleed you dry. So the question is not, can I be active? The question is this opportunity worth the rent I am about to pay? Now let's name the vehicle that makes this worse for many beginners: CFDs. CFDs are often marketed as simple access, but in practice they are a common path to leverage, and leveraged exposure is not free. With CFDs, you often face additional friction, spreads, funding costs, structural pricing. So a trader can be right on direction and still lose over time because the structure charges you to hold risk. This is not moral failure, it is structural misunderstanding. Then comes what most beginners never see: microstructure. On very short time frames, price is often dominated by flows, liquidity provision, hedging, rebalancing, execution algorithms. Market makers and automation are not evil. They are the plumbing. But if you try to scalp noise without edge, you are swimming in a current with a small boat. And if you do not see the current, you will mistake turbulence for opportunity. Now the final trap, especially in Christian circles. When people do not understand the laws and do not understand the structure, they often replace reality with psychology. They replace a tested process with mindset. They replace measurement with confidence. They replace risk limits with spiritual language. But faith is not denial. Faith is not pretending uncertainty disappears. Biblical faith is not an escape from reality. It is living within truth. It is knowing what is true, knowing the laws, and walking inside that truth with wisdom, because truth sets you free. And ignorance does not make you holy. Ignorance makes you exposed. That is not about prideful knowledge. That is about survival. If you reject structure and truth, you will drift towards superstition. And superstition is exactly how trading becomes gambling. Emotion replaces structure. Urgency replaces wisdom. Confidence replaces truth. In markets, that freedom begins when you respect reality: time, risk, volatility, costs, and consequence. A mature participant in markets does not say, "I will win." He says, "I will survive volatility." Because survival is the first form of wisdom in any uncertain domain. So why do Christians confuse trading with gambling? Because most retail trading is structured like gambling. Short horizon, synthetic volatility through leverage, friction-heavy instruments, and false measures. Markets do not require you to worship money. They require you to respect reality: time, risk, volatility, and consequence. And the Lord, who is the master of times and circumstances, will audit every illusion. If you want the full framework, written by a Christian who traded in the institutional world, not to give you signals, but to give you a disciplined way to think about time, risk, and stewardship, it is not a shortcut. It is a structure. And the goal is not to accumulate money. It is to redeem time.
Lift up your hands in the sanctuary and praise the Lord. May the Lord bless you from Zion. He who is the man